Hello and welcome. Let's talk about something that I know is on a lot of your minds. You're interested in cryptocurrency. You've heard the incredible stories of wealth creation, you see Bitcoin and Ethereum in the news, and you feel that pull, the feeling that you might be missing out on the biggest financial revolution of our lifetime. But at the same time, you're hit with a wave of anxiety. The volatility is terrifying. The charts look like a child's scribble. You hear about scams, hacks, and people losing their life savings overnight. The sheer noise of thousands of different coins, influencers screaming about the next 100x gem, and the constant fear of buying at the top or selling at the bottom, it's enough to paralyze anyone. What if I told you there's a way to cut through all of that noise? A way to participate in the crypto revolution with a strategy that is simple, proven, and, dare I say, relatively safe for the long term. A strategy that doesn't require you to be a trading genius or to stare at charts all day. A strategy designed to build wealth methodically, patiently, and without giving you a heart attack. That's exactly what we're going to break down today. The single best long-term crypto investment strategy for the average person. Now, before we go any further, it is absolutely essential that I make this crystal clear. I'm not a financial advisor. This is not financial advice. This video is for educational and informational purposes only. The cryptocurrency market is inherently volatile and carries significant risk. You should always do your own extensive research and consider consulting with a qualified professional before making any investment decisions. Your capital is at risk, and you should only invest what you are willing to lose. With that important disclaimer out of the way, let's begin. To understand where we're going, we first need to understand the landscape. Let's take a quick pulse check on the current market sentiment. As of right now, the market is in a state of cautious neutrality, leaning slightly towards apprehension. The explosive, euphoric highs of the last bull run are a distant memory, and the painful lows of the bear market have instilled a healthy dose of fear and respect for volatility. The Crypto Fear and Greed Index, the tool that measures market motion, has been fluctuating between neutral and fear. What does this mean for us? It means the tourists are gone. The get-rich-quick crowd has been washed out. The people who are still here, still building, and still accumulating are the long-term believers. For a long-term strategist, this is not a scary environment, it's an environment of opportunity. Fear is a signal to pay attention. Extreme fear is often a signal to start accumulating. Greed, on the other hand, is a signal to be cautious. Our strategy isn't about predicting the next move, but about using the sentiment as a guide. When others are fearful, we are disciplined. When others are greedy, we are prudent. This is the mindset of a long-term winner. So, what is this magical strategy? It's not about finding some obscure altcoin before it moons. It's not about leverage trading or yield farming complex DeFi protocols. The strategy is built on three simple, powerful pillars. Pillar number 1, what you buy. Pillar number 2, how you buy it. And pillar number 3, where you keep it. That's it. Let's break down each one. Pillar 1, what to buy. This is where most people get lost. There are over 20,000 different cryptocurrencies. It's a jungle. But for a simple, safe, long-term strategy, we are going to ignore 99.9% of them. We are focusing on the blue chips, the kings, the undisputed leaders of the space, Bitcoin and Ethereum. Why only these two, you ask? Because this strategy is about minimizing risk while capturing the overall growth of the crypto asset class. Bitcoin is the foundation. It is the most decentralized, most secure, and most recognized cryptocurrency in the world. It's increasingly seen as a digital store of value, a digital gold. It has a fixed supply of 21 million, making it verifiably scarce and resistant to inflation. Major corporations like MicroStrategy and Tesla have put it on their balance sheets. Entire nations like El Salvador have made it legal tender. The approval of spot Bitcoin ETFs in the United States has opened the floodgates for trillions of dollars in institutional capital to flow into the asset. When you buy Bitcoin, you are not just buying a speculative token, you are buying a piece of the most robust decentralized monetary network ever created. It is the reserve asset of the entire crypto ecosystem. Then, there is Ethereum. If Bitcoin is digital gold, Ethereum is the decentralized internet. It's a global, open-source platform for decentralized applications, or dApps. It's the foundational layer upon which thousands of other projects, from DeFi to NFTs to blockchain gaming, are built. The vast majority of innovation in the crypto space happens on Ethereum. Its transition to a proof-of-stake consensus mechanism, known as the merge, dramatically reduced its energy consumption and changed its monetary policy, making Ether a productive, yield-bearing asset. With the potential for spot Ethereum ETF on the horizon, institutional interest is also firmly set on Ethereum. It's the silver to Bitcoin's gold, but it's also so much more. It's the engine of Web3. By focusing your long-term portfolio primarily on Bitcoin and Ethereum, you are making a bet on the entire crypto industry to succeed. You are avoiding the massive risk that comes with smaller, unproven projects that could easily go to zero. Could you get the 1000x return on some micro-cap coin? Maybe. But you could also lose everything. We're not gambling, we're investing. For a beginner, a portfolio split of something like 60% Bitcoin and 40% Ethereum, or perhaps 70/30 is a fantastic, well-balanced starting point. You get the stability and store of value proposition of Bitcoin and the innovation and growth potential of Ethereum. Now we move to pillar number 2, how you buy it. This is, without a doubt, the most important part of the strategy because it's what protects you from your worst enemy, your own emotions. The method is called dollar cost averaging, or DCA. Dollar cost averaging is the practice of investing a fixed amount of money into an asset at regular intervals, regardless of the price. For example, you decide to invest $100 into Bitcoin every single Friday. If Bitcoin's price is high that Friday, your $100 buys you a smaller amount of Bitcoin. If Bitcoin's prices crash that Friday, your $100 buys you a much larger amount of Bitcoin. You do this consistently, every week or every month like clockwork. Why is this so powerful? First, it removes the impossible task of timing the market. Nobody, not even the most seasoned traders, can consistently predict the tops and bottoms. People who try to time the market often get paralyzed by fear when prices are low, waiting for it to go even lower, and they miss the best buying opportunities. Then they get swept up by FOMO when prices are rocketing, and they buy near the top. DCA frees you from this. The only decision you have to make is to stick to your schedule. Second, it smooths out your average purchase price over time. By buying in both high and low, you avoid the risk of deploying all your capital at a market peak. Over months and years, your average cost will be a fair representation of the market's journey, giving you a much more stable and less stressful entry point. And third, and most importantly, it weaponizes volatility to your advantage. In a volatile market like crypto, DCA is a superpower. When the market panics and prices crash 30%, the undisciplined investor is panic selling. The DCA investor, however, is calmly executing their scheduled buy, knowing that their fixed investment is now scooping up more of the asset at a huge discount. It turns moments of market fear into rewarding experiences. It builds discipline and a long-term perspective, which are the true keys to wealth building. Setting up a DCA strategy is incredibly easy. Almost every major reputable cryptocurrency exchange, like Coinbase, Kraken, or Binance, allows you to set up recurring buys. You can link your bank account and have it automatically purchase, say, $50 of Bitcoin and $50 of Ethereum every week without you even having to log in. You set it and you forget it. This is the definition of a simple, passive investment strategy. This brings us to pillar number 3, where you keep it. This is the safe part of the strategy. If you're investing for the long term, you need to think like a bank vault, not a wallet. Saying in crypto is not your keys, not your crypto. This is a lesson many have learned the hard way. When you buy crypto on an exchange, you don't actually hold the crypto yourself. The exchange holds it for you. This is convenient for trading, but it carries a significant risk called counterparty risk. If the exchange gets hacked, goes bankrupt, or is subject to government seizure, your funds could be lost forever. We've seen this happen with major exchanges like MT, GOX, and more recently, FTX. Millions of users lost billions of dollars because they trusted a third party with their assets. For long-term holding, the gold standard is self-custody in a cold storage wallet. A cold wallet, also known as a hardware wallet, is a physical device similar to a USB drive that stores your private keys offline. Your private keys are what give you ownership and control over your crypto. By keeping them offline, they're completely immune to online hacking attempts. Major brands to look into are Ledger and Trezor. Here's a practical workflow for our strategy. You use a reputable exchange to set up your recurring dollar cost average buys. You let your crypto accumulate on the exchange for a period of time, perhaps until it reaches a certain value, like $1,000 or $5,000, a threshold you are comfortable with. Once you hit the threshold, you withdraw the crypto from the exchange and send it to your own personal cold storage wallet. You do this periodically. This way, you get the convenience of automated buying from the exchange, while minimizing your long-term risks by moving the bulk of your assets into your own secure custody. It might seem a little technical at first, but learning to use a hardware wallet is a one-time process, and it's the single most important step you can take to secure your long-term investment. So let's tie this all together with a look at the bigger picture, incorporating some light technical analysis and a forward-looking statement. When we zoom out on a Bitcoin or Ethereum chart, looking at it on a weekly or monthly scale, the short-term noise fades away. What you see is a clear, long-term uptrend characterized by cycles. Each cycle consists of a parabolic bull run followed by a steep, multi-year bear market, but crucially, the low of each bear market has been higher than the peak of the previous cycle's bull run. This is a classic sign of a maturing asset class with growing adoption. A key technical indicator for long-term investors is the 200-week simple moving average. Historically, for Bitcoin, this line has acted as a generational buying zone. Anytime the price has dipped to or below the 200-week moving average, it has represented an incredible long-term accumulation opportunity. Our DCA strategy naturally takes advantage of these periods. While others are panicking that the price is below the 200-week, our recurring buy is happily scooping up assets at a massive discount. Looking forward, the fundamental drivers for this asset class remain incredibly strong. The Bitcoin halving, an event that occurs approximately every 4 years and cuts the new supply of Bitcoin in half, has historically kicked off major bull cycles. We have just recently gone through another halving. Institutional adoption is no longer a question of if but when and how much. The integration of blockchain technology into finance, supply chains, gaming, and digital identity is still in its early innings. The long-term thesis is that this technology will continue to embed itself into the fabric of our digital world. By dollar cost averaging into the two most important assets in the space, Bitcoin and Ethereum, and securing them in cold storage, you are positioning yourself to benefit from this multi-decade trend in the simplest and safest way possible. So, let's create a concrete action plan. Step 1. Decide on your allocation. For example, 70% Bitcoin, 30% Ethereum. Step 2. Choose a large, reputable exchange available in your country. Step 3. Set up a recurring buy for an amount you are comfortable with and can sustain. It can be $25 a week or $500 a month. The amount is less important than the consistency. Step 4. Purchase a reputable hardware wallet like a Ledger or Trezor and learn how to use it. Practice ending small test transactions before you move a large amount. Step 5. Set a rule for yourself. For example, every time my exchange balance hits $2,000, I will withdraw it to my cold storage wallet. Step 6, and this is the hardest part, have patience. This is not a get-rich-quick scheme. This is a get-wealthy-slowly plan. You are playing the long game. There will be times your portfolio is down 50% or more. Your DCA will continue. There will be times your portfolio is up 300%. Your DCA will continue. You are an accumulator, building a position over years, not days. Finally, what about taking profits? This is a crucial part of any strategy. A simple approach for a long-term holder is to not think about selling for at least one full market cycle, which is typically 4 years. A more nuanced approach could be to set rules for de-risking during times of market euphoria. For example, you might decide to sell 10 or 20% of your position when the fear and greed index is above 90 for a sustained period, or when the price is a certain percentage above a key moving average. The profits you take can be held in stablecoins or cash, ready to be deployed to increase your DCA amount during the next bear market. This allows you to realize some gains while still maintaining your core long-term position. In conclusion, the best long-term crypto strategy isn't a secret. It's not complex. It's a combination of discipline, patience, and a simple, robust plan. By focusing on the highest quality assets, Bitcoin and Ethereum, by using dollar cost averaging to remove emotion and build a position systematically, and by prioritizing security through self-custody in a cold wallet, you are building a fortress for your digital assets. You are setting yourself up to ride a long-term wave of crypto adoption without being shaken up by the short-term volatility. You are investing, not gambling. You are preparing for the future. Thank you for joining me on this deep dive. If you found the strategic breakdown helpful and clarifying, a like on the video would be greatly appreciated, and consider subscribing for more no-nonsense crypto content. The world of crypto doesn't have to be scary. With the right strategy, it can be one of the most exciting and rewarding journeys of your financial life. Let me know your thoughts or your own long-term strategies in the comments below. Stay safe and invest wisely.